There are two segments of the market wherein the participants can actually trade in. One is called the cash segment and the other one is called as the futures and options market. The cash segment, what happens is the delivery, buying and selling happens through the exchanges, and there is an actual transfer of shares from one demat account to another demat account. However, on the flip side, let me also explain what the futures and options market actually looks like and how it actually functions. So a future contract allows you to buy or sell an underlying security or an index, which is you can do that at a predefined rate and a predefined date as well. While on the other side, the options contract, those are of two types. One is the call option as well as the put option. Now, a call option essentially gives the buyer the right but not the obligation to buy the security at the end of the tenure. While on the other hand, a put option gives the seller the right but not the obligation to sell the security when the option actually expires. Now, what's the purpose of these instruments and how market participants actually use them is, one is of course to hedge it against the portfolio that they have. So the futures and options can be used in multiple strategies to hedge long-term portfolios in the market as well. And the other one is of course the short-term trading bets that market participants actually do, which is speculate on the markets using leverage positions as well. So these are the two purposes of the futures and options market as well. There are certain terminologies that are involved in this particular market segment as well. One is there are three option contracts generally for stock futures and options which are available, which is the current month, the near month, as well as the far month. Now the current month contract, for example, today is the start of the September series. So the September contract is called as the current month. The October contract will be called as the near month, and the far month would be the November contract that is available. However, as far as the index futures and options are concerned, there is a slight bit variation to that as well. The futures are available on a monthly basis. However, the options for the Nifty as well as the Nifty Bank, those are available on a weekly basis and they expire on every Thursday that we have. While on the flip side, the stock futures and options, those actually expire on the last Thursday of the month. So for example, yesterday was the last Thursday of August. So that marked the end of the August series, and today being the first trading day post the last Thursday of the month marks the new series, which is the September series that we call it. So that is the terminology that one should also keep in mind while trading the futures and options market. Of course, there is a lot more risk that is involved in the futures and options space. That is, in the futures market, the risk is equal for the buyer as well as the seller. While in the option space, the risk is limited to the buyer and unlimited to the seller. In India, what we actually have is two indices which are available in the futures and options segment, which is the Nifty as well as the Nifty Bank. While we have 136 stocks that are available in the futures and options market, and the regular periodically evaluates and looks at all the stock futures that are there in order to determine whether the stock is eligible to be in the F&O segment or not. So for example, yesterday was the last trading day for three stocks, which is Century Textile, Ujjivan Financial, as well as Equities Holdings in the F&O space, because there were certain criteria that these stocks were not meeting, and hence they were dropped by the regulator or the exchange from the F&O segment. So there is a periodic review of this list, and as and when a criteria gets hit, a stock either gets included or excluded from the F&O segment.